Everyone is asking who wins from AI. I mean, it's the defining question of the modern market, right? But honestly, that's the wrong question. The better question, the one we really need to be focused on, is who actually captures the profit, who pays the bill, and who ultimately gets commoditized. Welcome to today's Explainer. We're going to look past all the hype and examine the real, physical, and financial foundations of the AI economy. Our goal here is to separate the true stack owners from the high-risk capacity renters and figure out where all this money actually settles.
Here is a quick look at our roadmap for today. We'll start with the layered capital stack, break down the anatomy of AI infrastructure, and then identify the true physical bottlenecks. After that, we'll separate revenue from profit, look at the brutal math of return on invested capital, and finally, map out the ultimate winner hierarchy.
All right, let's dive right into part one, the layered capital stack.
To truly understand who captures value here, we first have to wrap our heads around the sheer, staggering scale of the capital flowing into this space. This isn't just a software story. We are witnessing an unprecedented deployment of physical infrastructure. To put it into perspective, McKinsey estimates that by 2030, a massive $5.2 trillion will be tied specifically to AI data center workloads in their base case. And this isn't some far-off prediction. According to Synergy, cloud infrastructure services are already running at an annualized rate of over $500 billion. Much like the railroad, telecom fiber, and early internet booms, this is a colossal mobilization of physical capital. And the companies capturing that spend? Well, they differ drastically depending on exactly where they sit in the stack.
Moving on to part two, let's break down the anatomy of this AI infrastructure.
We really need to see how this builds into a complex ecosystem, because the biggest upfront spenders aren't necessarily the ultimate profit winners. Tracing the capital flow here, you can see how demand from training and inference hits the hyperscalers first. But those cloud giants, they rely heavily on merchant accelerators, like the ones from NVIDIA, and massive networking fabrics. Those accelerators, in turn, depend entirely on foundries and advanced packaging, and underneath it all is a foundational grid of power and cooling. The capital trickles down through each layer, but the ultimate target for absolutely everyone on this board is infrastructure ROI.
Which brings us to part three, the true physical bottlenecks.
You see, the primary bottleneck isn't just securing GPUs anymore, it's evolved. We are now dealing with a rigorous four-part constraint system. Think about it this way. Even if you have infinite GPU demand, a chipmaker's revenue can be completely capped by advanced packaging limits. AI servers aren't just chip problems, they're packaging and interconnect problems. This dynamic makes TSMC, specifically with its CoWoS packaging technology, the classic scarcity economics winner. They sit right at the center of this physical bottleneck as an indispensable manufacturing choke point.
But then there's the power issue. Power is now a system-level bottleneck. The International Energy Agency projects data center electricity consumption will more than double to roughly 945 terawatt-hours by 2030. That is an enormous amount of electricity. With accelerated servers driving around 70% of this new load, cooling, thermal, and electrical equipment vendors become major second-order winners, because simply put, you can't run the software if you can't cool the hardware.
And we absolutely can't forget how these clusters actually talk to each other. Delaware reports that Ethernet has more than doubled the size of InfiniBand as the leading AI scale-out fabric in 2025. Networking is a hidden choke point here. As these server clusters grow denser, if the switch fabric can't keep those incredibly expensive GPUs fed with data, utilization drops. And in this game, low utilization is basically financial death. That's why high-speed networking providers are so utterly essential to the stack.
So let's unpack part four, revenue versus profit winners. Generating top-line revenue from AI is very different from capturing durable, long-term profit, and the market confuses the two all the time. The big three hyperscalers, AWS, Microsoft, and Google, still absolutely dominate demand aggregation. That is a massive structural moat. By controlling enterprise demand, they can easily amortize their massive capital expenditures and maintain high utilization rates. Meanwhile, you have players like Oracle, holding a smaller 4% share, successfully using specialized, capacity-constrained AI infrastructure to aggressively carve out their footprint.
The contrast in how value gets captured is really fascinating. On one side, you have scarcity winners like NVIDIA, pulling in extraordinary rents with 71.1% gross margins, highly protected by their CUDA software lock-in. But the hyperscalers are fighting back. They're deploying custom silicon, like Google's TPUs, which run anywhere from $1.20 to $12 an hour to drastically lower their inference costs.
They use these proprietary chips to cross-subsidize their broader software and cloud ecosystems.
And when we compare hyperscalers to the specialized AI neoclouds, the difference in moats becomes super clear. Neoclouds rely heavily on blistering speed, fast deployment, and preferential GPU access. Now that makes them operationally elegant for sure, but financially fragile. They carry enormous utilization risks. Hyperscalers, on the other hand, have massive capital access and deeply entrenched distribution moats. They can casually absorb multi-year payback periods that would outright crush a smaller competitor.
Look at the massive gap highlighted here. A 56% adjusted EBITDA margin sounds incredible on the surface, right? But an adjusted operating margin of just 1% reveals the crushing weight of depreciation and expansion CapEx. It's a perfect example of how EBITDA can severely flatter businesses that are taking on huge financing risks just to buy depreciating hardware.
This leads us perfectly into Part 5, Return on Invested Capital.
The crucial question is whether all this wild spending actually produces enough return on invested capital, or ROIC, for the companies footing the bill. Because ultimately it comes down to this brutal, simple math. Your realized revenue is just your price per hour multiplied by your utilization rate multiplied by the hours in a year. That's the whole equation. If utilization slips, or if market pricing normalizes quickly as capacity comes online, unit economics will deteriorate incredibly fast. Remember, you are renting out a rapidly depreciating asset. The clock is always ticking.
Let's game out the actual scenarios here. Under a base case of $4 an hour at 70% utilization, scaled operators can definitely see reasonable returns, generating about $24,000 per GPU annually. But look at the conservative scenario. A dip below $3 at sub 60% utilization completely fails to earn attractive returns for pure-play GPU lessors. If you drop to $2.50 at 55% utilization, well, that model only works for the absolute lowest cost owners who are able to cross-subsidize their losses elsewhere.
Finally, let's get into Part 6, mapping out the final winner hierarchy. Bringing this all together, how do we separate the durable long-term stack owners from the high-risk capacity renters? Well, the long-duration winners are the companies selling the scarce bottlenecked infrastructure today: NVIDIA, TSMC, and those critical power and networking enablers. But as we transition into the inference phase, the durable winners are the hyperscalers: Amazon, Microsoft, Alphabet. They win because they combine enterprise demand aggregation with their own custom silicon, which allows them to survive those long payback periods. Then we have the conditional winners. Oracle is growing rapidly, but their model is highly balance sheet sensitive. Neoclouds like Lambda offering H100s at roughly $3.99 an hour, or CoreWeave can experience extraordinary growth, but that growth is highly conditional. It depends entirely on high utilization, continuous access to funding, and avoiding a brutal price war. Cerebras pushing wafer-scale inference is a fascinating execution story, but again totally dependent on favorable token economics.
And then, unfortunately, we have the likely losers. These are the companies spending heavily without securing any real pricing power. If you are an undifferentiated GPU reseller without a defensible software moat, or a general-purpose data center without firm power commitments, or a merchant chip challenger that simply can't get priority packaging allocation from TSMC, you are sitting in a structurally weak position.
So for the intelligent analyst or investor watching this, the practical framework is actually pretty straightforward. You favor the scarcity enablers and the vertically integrated hyperscalers. You hold high-quality compounding incumbents, but you must strictly avoid any business model that requires permanently elevated GPU spot pricing just to break even. Pure capacity stories operating like scarcity never normalizes, those are a massive risk.
Ultimately, the first winners in any gold rush sell the shovels. But the durable winners are the ones who figure out how to turn those shovels into recurring cash flow. As the market inevitably shifts from the training phase to the brutal, commoditized economics of inference, we have to watch very closely. Will the profit pools migrate entirely away from merchant silicon scarcity and toward operators with custom silicon, software control, and the lowest cost power? That, right there, is the multi-trillion-dollar question.
Thank you for joining me for this explainer. As you review your own outlook on the AI boom, ask yourself, are you positioned with the enduring stack owners, or are you going to be left holding the bag for the capacity renters? Please remember that this overview is strictly for research and educational purposes and absolutely does not constitute financial advice. Keep analyzing, stay sharp, and I'll see you in the next explainer.